Hello, this video shows a streamlined method of how to comprehensively analyze the two key financial statements, income statement and balance sheet. And as I later demonstrate, this is the kind of evaluation that should precede financial ratio analysis, which many students and analysts are more familiar with. And so in analyzing financial statements, there are two aspects of performance to examine on the income statement. First, compare the top line, revenues or sales, to the bottom line, the net operating income, right here, to get a sense as to whether they are in sync. In a nutshell, that's the net profit margin, right, which is net income divided by sales right here, right, because you're trying to figure out how much you're earning per dollar of sales after all expenses have been accounted for. Now the second is to examine changes in the three operating cash outflows highlighted here in gray. All right, this is going to be cost of goods sold, uh, operating expenses, and financing expenses, specifically interest expenses and leasing expenses if you have those. Now I call these the three monsters because they try to eat your lunch, as it were. And you're doing this in order to determine if there is a disconnect in their relationship to revenue as you examine the firm's performance from one year to the next. All right. In this example, we find that until the current year, revenues grew by about 7%, as you can see right here, while net income pretty much paired that trend right here, growing at a healthy rate of 8 to 9% per annum. And you can see that that kept net profit margin at a fairly steady rate of about 11% from year to year. Now though, notice that in the most recent year, right here, revenue jumped by an impressive 12%. And this should be good news. Unfortunately, observe that in spite of this remarkable growth in revenue, net income actually declined rather significantly by more than 40%. So what happened here? The answer lies in what happened in between the top line and the bottom line. To identify the culprits, we carefully examine how each of these three monsters have changed over the period. Doing this should guide us on how best to devise a corrective action going forward. Now, looking closely, we can be sure the problem is not due to cost of goods sold, because as you can see, it pretty much grew in line with sales. Okay, a tiny bit higher in the most recent year of about 13%, but that's not so disruptive. Clearly, we can see the problem comes primarily from the rapid jump in operating expenses, which grew by 46%, and also financing expenses, which increased by a whopping 71%. Generally, when these three outflows, cost of goods sold, operating expenses, and interest expenses, grow in line with or at a rate lower than revenue, we should be okay. But if any of them consistently rises at a faster rate than revenue, all kinds of bad things can happen. And so in looking at this story, we want to make sure that these three guys right here in gray are not growing at an extraordinarily higher rate than the source out of which these expenses are made. The situation we have here is unsustainable, as you can see, because clearly the company is headed for disaster if one or more of these expenses continues to rise faster than revenue. So we're going to provide some context to this. Now, typically, when companies expect revenues to rise by a significant amount, as appears to be the case here, where it grew by close to by about 12%, a whole lot more than it's been growing over time, they're going to make additional investments in assets in order to support this expected jump in revenue. For many manufacturing and retail firms, if they expect to sell more, they increase their inventories. As you might recall, this typically happens ahead of the Christmas season in many countries. So, and that's what happened, or at least appears to have happened here, except that inventory, if I may skip over to the balance sheet, jumped by a whopping 65%, as you can see right here. Fixed assets have also been growing at a rather steady rate over the years, at a rate greater than the rate at which revenues have been growing. So these are worrisome trends because unless the firm is pre-purposing its assets for strategic reasons, for example, if the firm is expecting a bumper harvest in the next couple of months or quarters or years, then assets, especially current assets, and most primarily inventories, should typically grow at about the same rate as revenues because we make sales out of inventories. But when they are growing at a rate much faster, then we're going to have a whole lot of excess inventory, and that's going to hurt our profitability. So as you can see in this example, there is a disconnect. And how did the firm finance this huge increase in inventories? The answer is it did so by borrowing heavily. Look down here and you can see that short-term debt shot up by 52% and long-term debt all but doubled, as you can see right there. Evidently, this dramatic increase in debt led to the disproportionate increase in interest charges, which we observed earlier on the income statement. If I may go right back there, and you can see that it grew by 71%. So well, how might the firm begin to remedy this situation? Obviously, it would need to trim some of the fat off its operating expenses to try and bring it in line with revenue growth. And as you can see, the firm plans to do just that with a projected 21% reduction in overhead. Unfortunately, this means the firm may have to reduce labor costs, maybe lay off some workers, and also cut down on some of its running expenses like postage, handling, transportation, and the like. Secondly, the firm may need to figure out a way to reduce its debt burden so as to reduce its overbearing interest expenses. In this example, the firm plans to, and if I may go right back to balance sheet where we find the liabilities, the firm plans to restructure its capital structure by paying down some of its debt, specifically the more expensive long-term debts, which it plans to reduce by about 28%, as you can see right here. Okay. But where will the firm get the money to pay down debts? Well, remember, there really are two sources of capital, debt and equity. So obviously, the firm would first need to retain all of its current earnings. And all of the net income, if I go right back here, all of this net income of 6968 is going to have to be plowed into toward the pay down of debt. And this is going to kick up its retained earnings balance to 58, as you can see right here. So when we add current net income to the current retained earnings balance, so it's going to shoot up to this level. Now though, but even after that, we still have some shortfall to fill. The firm would have to raise additional equity in the form of new common stock by almost, as you can see right here, by almost 150%. So with a reduced debt, we can expect lower interest charges going forward. In this example, let's go right back to the balance sheet. In this example, by 33%. And so with all these adjustments in place and given the projected 12% rise in revenue, the firm expects its bottom line to sweetly rise by 120%. And so in conclusion, when analyzing financial statements, we should first examine the relationship between the top line and the bottom line, meaning revenue and net operating profits, to see if there has been a disconnect between the two. Where one exists, take a look at the three sources of cash outflows: cost of goods sold, operating expenses, and financing expenses to identify the culprit. Next, we proceed to the balance sheet to find out if there has been a disproportionate increase in assets and how that was financed. And finally, we're going to have to make a judgment as to how the firm's operating expenses and financing position can be rearranged to bring operations back in line. And this is the kind of analysis that you want to conduct prior to financial ratio analysis. I hope you enjoyed it, and let's keep learning.